Hello, everyone. It's Friday, February 3rd. We're going to do recorded version today. Have a few things on the go later today. So just wanted to give you an update on what's happened this week. It's first week of February, I suppose. We've started February's midweek. Lots going on. We had the U.S. Central Bank raise rates, and there's been, the market rallied off of that. Been lots of research context talking about, is it dovish, is it hawkish? We've had a pretty good start to the year in equities and bonds. And so, on that kind of initial news on Wednesday, and then markets continued to do well yesterday. We had Meta release some good results. Stock was up about 24% yesterday. And so lots going on today or last night. We had a couple of other big tech names, Google, Apple, Amazon report, all of them softer than expectations. And, yeah, on the surface, I guess that's probably bad for the stock price right now. But when you think about the financial conditions that I think we're under right now, it's a better sense for the gauge for where we're going, which is I think the economy is slowing, and I've been saying that now for a while. And in turn, I also think inflation's slowing as well. So that's some of the news today. Looks like the markets are going to give back some of the gains we've had this week, but continue to follow that pretty closely. But that's where it is. So without going into too much detail, I'm going to go through a couple of slides, give you an update on anything that I've done in the portfolios or thinking about doing. But I thought we start with the presentation first off, and then we can jump into anything happening in portfolios. All right. So just bear with me. Just going to share the screen here. Okay. All right, so here we go. Our central bank's behind the curve. This is a great research report put out from Fidelity this week. Fidelity was kind of giving an update, their big picture update. They had their economists, they had their investment officers, portfolio managers, everyone kind of talking about their views around where we are right now. This is one of the reports that came out that I thought was pretty interesting. It's good to be able to go back and look and say, where are we? Are they ahead of the curve? Are they behind the curve? Will they continue to tighten? At the present pace in the U.S., it looks like they're going to continue to tighten for a little bit longer. I think I've had this question about, is it priced in or not? And I think the answer is that bonds peaked, it looks like, in February of last year, or sorry, excuse me, in October of last year. And since then, the bond market's essentially been pricing in a mild recession. And so I think the rate at which the central banks continue to tighten is going to decide whether it ends up being a little bit more deeper or protracted. But we continue to watch this pretty closely at this point. So I haven't put this one up in a while, but this is Jeremy Grantham's. He always puts forward a view on what's happening ahead based on valuations. He's a valuations guy. His research is fantastic and certainly worth looking at. His company is GMO. Great research. Somebody sent this along to me, so thank you for that. But again, his view continues to be such that he thinks that international and emerging markets are underpriced and U.S. markets are overpriced. And so I guess if we think about how this could play out, at least over the next couple of years, is if the view is that the developing world, primarily North America, and a little bit Europe, is heading into a recession. U.S. dollar's been pretty strong. Like, these are all things that put pressure on the international markets. And if we come on the other side of this, when they start cutting rates and we start to see the world go in the other direction where rates get cut, the QE, they start to stimulate the economy again. What happens is US dollar tends to weaken in that backdrop, or at least it has historically, which has tended to be quite good for international emerging markets. And if we're starting at a lower point already, I think this is worth being conscious of as I think about portfolio construction. One of the things that I talked about last year was we started to look at China and some of the Chinese internet stocks and things like that. Well, not everyone wanted to be invested in there, but just from a thinking about how that's played out, KWEB ETF is up about 25% this year, and that's just kind of the backdrop of where we are. So if we look at a lot of the international markets right now, they're quite a bit cheaper than the U.S. market. So this is something that I think about. It's not something I want to aggressively put in place today, but it's something that I'm very conscious of, and I think there'll be a fantastic opportunity this year to be a bit more aggressive there. And so if we look at the world in multiple ways, one of the places that I think is important to think about just from a big scale is what's happening in Japan. And so Japan's been doing quantitative easing now for a couple of decades. And so, they pegged their yield curve at 25 basis points. And as a result of that, the yen was down about 40% last year versus US dollar. And so now they raised that peg to 50 basis points. And there's some talk about them completely removing the peg, and that would certainly cause the yen to rally significantly. And if you think about what does that mean from an investment perspective, well, certainly I could buy the yen as an option, but who would benefit most likely from this would be the financial system in Japan. And so the Japanese banks, for the first time in a very long time, might be a worthwhile adventure to invest in. So I think about that from a construction perspective. And so just on the last one, I had a client send this and draw this to my attention this week. This is the 2022 corruption index, just looking at the world on the scale of what and where are kind of the safest countries to invest in. And so it's a great presentation, lots to look at if you're interested in something like this. But what was most noteworthy for me when I did have a look at it is we see some of the significant movers. And if we look at that, Canada actually was one of the significant movers to the downside. And so I've tried to dig in and understand a little bit around why and how, and it's certainly interesting to think about what's going on in the political world globally, but certainly at home as well. So thanks to the client for sending that along as well. So, and we'll wrap up here. It's, I think we're going to get a bit of a correction into the markets today from a positioning perspective about what to do and what I've done. I've continued to be patient here for the last probably 4 or 5 months. I've been quite a bit less active than I've been over the past couple of years. So I've more said, let's look at these companies, let's see the opportunities that are presented. As we get a correction into some of the bigger tech names like Amazon and such, I really think these are going to present some good longer term opportunities. So Amazon's a company that have known for a very long time, but something that I think has good potential as we move through the other side of this. And so I'd be taking my time looking at those. And bonds, again, I think they're pricing in a mild recession. If it gets a little bit deeper than that, then bonds continue to rally. So I maintain the position with owning treasuries in Canada and the US, and certainly excited about where I think those holdings can go over the next 6-9 months. So right now, continue to be patient, watch that. As for next week, not a lot dramatic planned. We'll continue to watch these signals and see what's happening. Had a nice move out of the gate. Considered trimming, potentially taking some profits in a few spaces, but right now I've been patient and waiting to see how this plays out in the market. So thanks everybody. Hope you have a great weekend. If you want to continue to book meetings, certainly we have the booking app in my email, or feel free to call Scott or I and book in a meeting and review, and been keeping busy doing that. So appreciate your time. Have a great weekend, and we'll see you next week. Thanks.